You are welcome to this seminar by Raghuram Rajan, a good friend, senior fellow, former governor of the Reserve Bank of India, former chief economist of the IMF, distinguished professor at Chicago. So it just couldn't be a more appropriate topic for you to speak about, but more appropriate in general. Liquidity dependence, why shrinking central bank balance sheets is an uphill task. Thank you.
Okay, well, thank you very much for having me. And I'm going to tell you a little more about central bank balance sheets, hopefully, than you know, and possibly than you care to know. So let me talk a little bit about why this is important. We've had a tremendous expansion in central bank balance sheets. In lay language, we've had a tremendous amount of money printing. Actually, it's not actual money, but it's reserve creation. But there's been a tremendous amount of it since the global financial crisis. And what this involves is the central bank replacing long-term bonds of a variety of kinds with perhaps the most liquid asset on the planet, which is central bank reserves. And so the big question is, you've put all this liquidity out there, and yet there are surprisingly fragile conditions in money markets, especially when you withdraw some of this liquidity. And remember, you're withdrawing from levels which are many times higher than when you started putting the liquidity out. So what's going on? You had the repo rate spike in September 2019. You had a tremendous dash for cash across global markets in March 2020. And of course, recently we had the turmoil in UK gilts in September, October 2022. The broader question, you can point to specific factors in each of these cases and say, this is why this happened. In September 2019, it was the Treasury expanded its account at the Fed, and so there was less left for everyone. There's still plenty left, much more than there was before. So that can't be a full explanation. Something else was going on. We need to understand what. So the question really is central bank balance sheet expansion and liquidity stress related? Does the act of expanding your balance sheet itself set the conditions for what may happen later on? And what Acharya and I did was we started out by writing theory. Just some toy models of central bank balance sheet expansion and what this would do, primarily focusing on the fact that it had to run through commercial bank balance sheets, and commercial banks may do something that essentially creates the problem that we see down the line. We wrote that and people said, where's the data? I mean, this is just theorizing. How does this have anything to do with the real world? And that's when we actually looked at the data. And that's this paper. So it's different from the typical view. We're going to look at QE and what that does, but it's different from the typical view, which looks essentially at the effects on commercial bank asset sides and on their capital. What we're going to look at is commercial bank liabilities side and the kind of instruments that it issues. But that's getting ahead. Let me talk very simply of what happens when the central bank expands its balance sheet. This is a process known as quantitative easing. One way it can do it is purchase from the banks long-term assets. So think of the left-hand side as the initial balance sheet conditions. The right-hand side is what happens afterwards. So let's move from the Federal Reserve balance sheet on the left to the Federal Reserve balance sheet on the right. The Federal Reserve buys Treasury securities, so it adds to its assets by $1. But how does it pay for it? Essentially, it gives you IOUs, which are in the form of reserves that you hold at the central bank. These are reserves held by the banks. And these are extremely liquid assets on the bank balance sheet. So what happens to the bank balance sheet? If it's the one that sold reserves, the bank balance sheet gets transformed. It has fewer securities. it has more reserves on its asset side, nothing need happen on the deposit or the capital side, the liability side. Typically, though, once you've changed the nature of your assets, you've got more short-term assets on the asset side, you may rebalance your capital, and we want to see what happens there. Here's another way the central bank expands its balance sheet, this time by purchasing from the public. Okay, so think of some hedge fund or some household having treasury securities, and what happens when the Federal Reserve purchases from these entities? Again, left-hand side is pre-purchase balance sheets, right-hand side is post-purchase balance sheets. Now you have three balance sheets at work. The Federal Reserve issues reserves to buy treasury securities. That's the same as what we saw earlier. What happens to the public? The public basically sells the treasury security to the Federal Reserve, but the public cannot hold reserves directly. Instead, what it does is it takes the money it gets from the Federal Reserve and deposits it at the central bank. So it gets deposits it at its commercial bank. It gets a deposit on the commercial bank. And finally, the commercial bank now has an expanded balance sheet. So remember in the previous case, the commercial bank's balance sheet did not expand. It was a pure asset swap. Here what happens is its balance sheet expands. It has reserves at the Fed, and it now has more deposits. Again, it can rebalance, but this is what happens when the Fed buys from the public. So the first question we have to ask is, okay, the Fed did all this when it did 3 layers of QE. What exactly happened to the commercial bank balance sheets? And then we'll go from there. So we want to ask, how does the Fed balance sheet expansion affect the size deposits and demandability of deposits of the banking sector? Do other demandable liabilities issued by the banks also grow with reserves? And do these claims shrink when the Federal Reserve shrinks its balance sheet? Okay. So what are the answers? Well, first, when the Fed expands its balance sheet, what we find is actually the deposits at the commercial banks expand significantly. The demand deposits expand more than 1-for-1 for the reserves that are issued. And instead, for the commercial banks shrink the time deposits they've issued. Put differently, the commercial bank has a very liquid asset now sitting on its balance sheet. It basically finances the asset with very, very short-term liabilities. Uninsured, it turns out many of these are uninsured demand deposits, or what are also called wholesale deposits on its liability side. Why is this important? It's important because there is a sense that somehow you put a whole lot of this liquidity out there and it's sort of free liquidity. It turns out the way it's financed is with demandable claims, which are claims on liquidity. So there's not so much free liquidity available. In fact, commercial banks go further. They not only issue demand deposits against it, they also write lines of credit against the reserves that they hold. In other words, they commitments to offer credit to anybody who wants it at a time that they need it. These are further claims on liquidity, right? So what happens then for every dollar of reserves that the banks have is they've written a lot of claims against those reserves at the time of expansion. So there's not a lot of spare liquidity left floating around. This is also one reason why, one of the views on how quantitative easing works is what is called the portfolio balance view. I've taken out a whole bunch of long-term assets from private balance sheets. And so what they're going to do when I've taken out all these long-term assets is they're going to go and rebuild by buying long-term claims, perhaps funding long-term projects, and that's going to be a way you increase activity. Well, that doesn't fully take into account that offsetting these very liquid assets that are put out, banks write a lot of short-term claims. which makes it harder for them to make long-term loans, from their balance sheet. So that's just an aside. It's basically saying these ways of transmission may have implications for portfolio, for the portfolio balance theory. And I'm happy to answer any questions as they come up.
So here's a quick one. So I show the sizes, the central bank's balance sheet in my Econ 1 class. It's phenomenal. I also say the Fed could undo this. You're saying they can't. So I don't really understand.
So that's the second part. They can certainly undo it if everything sort of reverses in the way it is supposed to, right? So they've built it up by issuing reserves. Now, what they do when they buy back, when they sell the bonds on their balance sheet and buy back reserves, is it should have the effect of shrinking bank balance sheets. That's where it turns out it doesn't work that way. Bank balance sheets stay the same as far as these claims on liquidity goes. All they do is they reduce the reserves they hold, increase to some extent the treasury securities they hold, but a lot of that also happens with the private non-banking system. The bottom line is when you look at the demandable claims on these banks, they don't shrink during QT. And that's the problem, because they don't shrink, but reserves shrink. Yeah. And that creates a much more sort of fractional reserve system than before. And that's where the liquidity problems may emerge.
Can you say anything about the social value of the expansion in demandable claims that comes about? So first of all, is it somehow providing more liquidity to the non-financial sector or contingent liquidity in general, or is it just displacing something that would happen already? If the answer is providing more, well, does that have real social value for it?
It could. So here's what happens, for example, with lines of credit. It used to be that banks used to lend directly to entities. What you see post-global financial crisis is them not holding a whole lot of loans to corporations on their balance sheet. There's a lot more of what are called, they make the loan initially, then they sell them off to collateralized loan obligations, CLOs and people like that. They hold the loans, but banks still provide a liquidity function to those entities or to the firms directly. The firms have borrowed from long-term entities or from the CLOs who can't provide emergency funding. So they get a line of credit from the bank. So what is happening is banks are no longer doing balance sheet activity. They're doing off-balance sheet or contingent lending. Whether that structure is more efficient or not, I don't know. But that's what they've moved to. They're providing liquidity rather than holding assets on their balance sheet. That may be more capital efficient from their perspective. Again, hard to say whether this is socially valuable. Right. Okay, so the bottom line is we enhance liquidity dependence in the banking system, essentially because a mountain of claims on liquidity are based on a relatively small portion of reserves. This then means the central bank has to come in every time there's a situation of stress. So unwinding QE can be very difficult because the commercial banks don't cooperate as much in that process.
Why can't they just do it?
What's that?
Why can't they just start? They built up the balance sheet.
That's the key question in the talk. Why aren't they shrinking their balance sheets? Why are they not unwinding it? What's the hysteresis in this process? And I have some thoughts. I'll come to that.
Can I just ask a question? So one big change in the last couple of years is the Fed's now established the standing reverse repo facility. And in the latest H4.1, the reverse repos are at 2.6 trillion. The reserve balances are at 3.1 trillion. So maybe you can come back to this later in your talk, but in some way that sort of would be another kind of scenario for your slide where you were showing, the case where the public deposits with the banks and then the banks deposit reserves at the Fed. the reverse repo is effectively a way for a much broader slice of the public to, in effect, deposit directly at the Fed.
You're absolutely right. What happened was, as the Fed expanded its balance sheet beyond a certain point, the banks basically refused to take more. They had, pretty expanded balance sheets, and then the overflow went into the money markets, which did reverse repo transactions with the Fed. That's about 2 trillion. And but my sense is that will first come off as the Fed does QT this time around, and then you'll get into the core, which is with the banks. And then we have to see whether something that played out the last time the Fed sort of reduced its balance sheet will play out again. So I think we have some time while we are running through the reverse repo transactions, which are essentially excess reserves now being put back to the Fed by the money market funds. That sort of seems, that won't be influencing the things that we're talking about when that gets taken out. But when you start taking out bank reserves, bank-held reserves, that becomes more problematic. I thought you were also going to a different point, which is the Fed, since these events, has created a standing repo facility, not the reverse repo, but repo, allowing a wider variety of entities in the market to get reserves from the Fed against the securities they hold. The problem with that is it's untested. Remember, banks have the access to the Fed window where they can put their securities to the Fed window and get reserves against it. This is the discount lending window. But there's a huge amount of stigma for banks to go there. And it's not clear yet that there's no stigma associated with the standing repo facility. It's very little used, which means when it's used, people are going to say, who's coming to this window? Are they in trouble? Should we start running on them? And so runnable entities coming to these windows can be problematic because it sends a signal that they are in trouble. So we don't know if they work, but that's something the Fed has created since the events that we're going to talk about.
On the positive repo side, what's the current balance?
On the reverse repo.
No. You were just talking about the repos, not the reverse repos.
Oh, it's tiny.
Yeah,
It's not used at all. Yeah, it's tiny. It's tiny.
Yeah, I was going to ask. I mean, is the ratchet nature of QE just fundamentally that the banks are seeking to get around the reserve requirements, and once we've expanded the balance sheet, that's given them an in to weaken the reserve requirement?
The reserve requirements are not binding at all. They're really quite small. I think what's going on really, so you want to preview the answer to?
No, I'll let you.
Well, okay, let me postpone because I think it's a central question.
Okay.
It's the question we have the least sort of satisfying answers to. But I'll give you some thoughts on what's going on there. So here's the traditional view. So why does our view matter? The traditional view is you have an exogenous demand for liquidity. The Fed comes in and puts a whole lot of liquidity out there. The price of liquidity falls. Everything is nice and dandy. There's no reason for the Fed to not supply these reserves as much as is wanted. Money has zero price for the Fed to create it. Why not do more of it? Our view is slightly different. It's saying that, look, once you create these reserves, not only is there the exogenous demand, but there's new demand, which is the banks write a whole set of claims on it. In other words, the supply of reserves creates its own additional demand, which is new claims written by banks. And then that creates a different set of conditions when you want to withdraw these reserves. It's ratcheted up the demand, and it becomes harder to withdraw them. Is this a problem? That's where the real question emerges. What do these do to your monetary policy stance? Because the Fed is ultimately about monetary policy. If you have to shrink your balance sheet when you're tightening monetary policy, it may become much harder when you have these claims written against reserves. You cannot shrink your balance sheet as fast. And you may, the other issue that comes about is how much are you financing of the government balance sheet? To what extent is this monetary financing? And is it hard to withdraw this also? Okay. So not a problem in bad times, not a problem when inflation is not an issue, not a problem when the government's fiscal situation is fine. It starts becoming a problem when all these reverse because it then starts interfering with with monetary policy. So here are the data. Sorry.
Is there a presumption that when you're tightening monetary policy, you need to reduce the size of QE? The alternative is just to pay slightly higher interest reserves.
Yeah. So why do you have to shrink your balance sheet at all, right? So our point is there may be. We'll talk about some of the ways it may interfere with monetary policy, but let's say you don't. Our point is that doesn't stay the equilibrium balance sheet then, because these guys continue issuing more claims on it. And therefore, the equilibrium size of the balance sheet, the minimal size of the balance sheet keeps increasing over time. If you think there's no concern with increasing that size, then we don't have a problem. If you think that that might interfere with a bunch of things, the price of liquidity, the funding of government, fiscal. Charlie Plosser has a view that once the Fed balance sheet is large, there may be political incentives to say, hey, you're funding the government, why don't you fund this infrastructure project in my state? So lots of other things could happen. But if you think that there are no costs then to the Fed's balance sheet expansion, then there's no problem. Okay? So it really depends on whether you think there's a cost. And we'll come to some costs later.
There's a question online.
Yeah.
Jeff
Flagger has a question.
Go ahead.
Raghu, hello. So along this time frame, not only is the Fed's balance sheet expanding, but it's also showing a more and more expansive approach to intervention when there's, as you say, you call them fragility, but they're kind of really, all we really know is that prices change a bunch. So when there's some volatility, the Fed seems to have a greater and greater propensity for intervening. I'm wondering how you're thinking about why banks write these contingent, these contingent claims. Is it that they naively think the reserve balances are going to be high forever, or are they taking kind of account of the extent to which the Fed might intervene? I mean, what's motivating them? Are they sort of naive, or are they? I mean, what's the motive there? I don't get it.
Great question. I think we have a variety of explanations I'll come to, but one of them is sort of organizational dynamics, right? You've started writing these lines of credit from your sort of lending arm. You've built relationships with the corporations. The Fed tightens. You can't say, hey, wait a minute. Liquidity is getting tighter, but we're going to withdraw these lines of credit because the Fed is tightening. We can't afford them anymore. So that organizational dynamic may push you to do this. We certainly think that the Fed willingness to intervene is part of the answer, that they've done it before. They'll come back in if things tighten up. Every time it tightens up, they come back in. So no worries. We're all going to be out on a limb if it happens, and the Fed will have no option to come back. That has to be part of the story also, which may be part of the concern with this kind of dynamic, that liquidity tends to get underpriced. We do more illiquid stuff because we know the Fed will get drawn in at the right time. So here is the picture of reserves. Each of those vertical lines indicates a new phase of what the Fed did. QE1 is the first phase, QE2 the second phase, and each phase ends sometime after that vertical line. So QE2 ends, and then reserves start drifting down a little bit. Then QE3, again, it goes up. And then we have somewhere in 2014, QE3 ends and reserves start drifting down. even before QT formally starts in late 2017. It drifts down a little more sharply till September 2019, when all hell breaks loose in the, for a little while in the treasury markets, and the Fed starts coming back in. And of course, it comes back in full force in 2020 March with a huge expansion in liquidity. Okay, so that's reserves. Here are deposits, right? And again, you can see with deposits that, it goes up when reserves go up, and it flattens out when QE sort of, look at the post-QE period, it sort of flattens out, comes down during QT, and then takes off hugely, post 2020. So deposits are correlated, but it turns out in deposits, very different pattern for time deposits and demand deposits. I'll come to that in a second. Bob, you have a question?
How do the reverse repos fit into this accounting?
Much later, much later. Reverse repos are beyond what we really study. They come in a big way after the flooding of reserves in 2020. That's when they come in a big way.
This is a question about your graphs here.
Yeah, so take the extreme right of the graph, where the green line sort of shoots up. That's sort of the blue line shoots up. That's when the reverse repos start happening further down the line.
Yes, the Fed regards the reverse repos as ultimately to replace reserves. Do you add them together? Or what? This is just an accounting question.
Well, so again, most of our analysis is before then, and we look only at the reserves at the commercial banks. We don't look at what's outside commercial banks.
That far right, this is John here, that far right one is very different in the data and in reality, because rather than buy treasuries from banks or from market participants, they simply sent people checks and deposited them into their bank accounts, and no wonder but deposits went up.
Yeah, there's some of that, but a lot of movement is also then uninsured deposits. I'll show you in a bit. These are rich people, and their $4,000 check is not going to make it for those guys. There's a lot of action with the uninsured deposits, and I'll show you. Just hold on. Series of charts. Okay, so this is lines of credit. Again, starting with QE1. In QE1, there's a lot of sort of noise, because what's happening is the system is also being rescued. Remember, the financial system, there's a whole lot of takedown of lines of credit as firms sort of run to lines of credit. These are unused lines of credit. So unused lines of credit, commitments by the banks to lend more, start taking off with QE2, QE3, and then taper off when QE sort of slows down, and then take off again after the pandemic QE. And remember, there's a lot of takedown of these unused lines. That's the first dip. When post-2020, you see the red unused lines go down. That's because firms are taking out lines of credit, are drawing on them, but then the unused lines go up even further during the post-pandemic QE. Okay, so here's the interesting way of putting the same data. Take the lines of credit and deposits, add them up, and divide them by the reserves. So this is how much claims on liquidity are relative to the reserves. And what you see is, as the QEs happen, there is a lot less claim on liquidity for a certain level of reserves. But then once QE ends, you can see, because you're shrinking reserves, especially during QT, you've got a much larger set of claims on reserves relative to the size of reserves. That's the sense in which the system is becoming much more a gigantic fractional reserve bank with much higher sort of dependence on a much smaller pool of reserves, okay? And that peak is obviously September 2019, when all hell breaks loose. In other words, what we're saying is the events of September 2019, when Treasury markets or get disrupted, is the straw that breaks the camel's back, because there's a lot more tightening going on before then, and that's reflected in these numbers. Okay, what I said was demand and time deposits differ. Again, these are reserves. These are demand deposits. They look like deposits. They're going up significantly, but look at time deposits. They're coming down. Now, nothing in the financing story tells you that you would see this. You would not necessarily expect time deposits to come down and demand deposits to go up, but it's consistent with a banking system which says, I have a ton of spare liquidity lying on the asset side of my balance sheet. How do I finance it in the cheapest way possible? I don't issue long-term claims on it. I issue demandable deposits on it. That's the way it's going to be cheapest to finance. Time deposits, I'm paying for maturity, I'm paying for duration. Why do I want to do that? Let me shrink time deposits. Okay, so that's consistent. The shift from demand to from time to demand is consistent, but would not be something you would expect simply from the financing story. Here's the uninsured deposits, John, that I promised I would show. Just in this complicated set of lines, look at the blue dashed line. That is uninsured demandable deposits. Again, in QE1, there's a change in definition of what is uninsured. Remember, a lot more was insured in the initial stages of the global financial crisis, and that changed once things stabilized. But look at QE1, look at QE2, look at QE3, and then look at the post-pandemic QE. The uninsured deposits are taking off almost in a vertical line with QE. So it's not the small guys. I mean, Annette has a whole paper on this is household demand. These aren't necessarily households. This could be wholesale deposits from much bigger entities, which are basically financing the banks with uninsured deposits. It is true that household deposits, the insured stuff, are also going up. That's the dashed red line. That's going up. But apart from QE, from the pandemic QE, which John, you rightly pointed out, they're flush with money. At other times, it's moving much more slowly than the uninsured deposits. So what this is suggesting is banks are going out, raising wholesale deposits to finance the treasury holdings that they have. And finally, look at time deposits. They're going down for both uninsured and insured. Okay. So
could I ask, isn't the story the last one, just the first story you told? The Fed buys treasuries from insurance companies, mutual funds, whatever. Those people turn around and lend them in wholesale markets to banks, and it's almost mechanical.
Yeah, except for the fact that, except for two facts. One, the commercial bank is shrinking its time deposits. And that is a real question. And it's shrinking beyond just the expansion in its balance sheet. There's an active reduction. So it is issuing claims which are much shorter in duration, relatively speaking. That's one. That wouldn't happen if it was just mechanical. The second thing is these guys are writing lines of credit. So they are writing claims on the liquidity. It's an active sort of choice rather than passive. I mean, but I'm perfectly, even if you say this is completely mechanical, that's fine. All it's saying is there's an offsetting claim on liquidity, which typically the literature sort of ignores, which is eating into those spare reserves, so to speak.
Help me understand this. So the Fed buys a treasury from an insurance company. The insurance company deposits in the bank. The bank takes that money and puts it into reserves. So the bank has more deposits and more reserves. Why does that make the bank go out and want to lend another dollar that comes from somewhere else to a third person?
No, it doesn't lend another dollar. What it does is it says, I have these spare reserves. My depositors aren't going to come at the same time for all their money. So what I'm going to do is I'm going to shift from time deposits to demand deposits because I have more reserves sitting on my balance sheet earning very, very low returns. So it issues more demandable deposits. It also says, look, I can also earn fees by giving firms lines of credit. Again, they're not going to come at the same time. In fact, they might come when I get a whole bunch of depositors who are anxious and want to put their money in the bank. So, I'm well diversified when I write all these claims. Let me write all of them and get fees on them, right?
I thought this ran into capital. I mean, Daryl Duffy keeps telling us that since there's this crazy thing, they need capital to hold reserves. I thought that operation would also run into the capital constraint. Is that not true?
It could for some banks. Many of the banks are really well capitalized right now and very far from the capital constraint. They are very far from the capital constraint. And remember, holding these reserves helps them on the liquidity side. There are these papers saying there are 6 or 7 different constraints these banks are dealing with. So what it helps on one side may hurt on the other. But the net effect is many of these large banks do hold these reserves, but they need to earn some money from them. And that's when they find creative ways of writing these claims. Okay, so let me quickly walk you through the time series evidence. But the problem with time series is we have one aggregate time series, which is limited data. And you can tell a lot of stories with that kind of data. But let me just show you some data from the aggregate time series. But really the persuasive part, I hope, will be the panel, where we're looking at the cross-section of banks and saying, what does a bank do when it has more reserves? Does it issue more demand deposits? And what happens to the pricing of deposits? Does it actually reduce the spread it pays on time deposits because it doesn't want the time deposits? It's more happy with demandable claims. That hopefully will convince you that banks are really active in this process and are doing things which essentially sell liquidity even as they have to hold liquidity. And that's why we have an offset, which then creates problems when liquidity shrinks. So here, let me skip the data. You're all very familiar with the data. What I'm going to look at initially is a crude way of looking at the aggregate. Look at changes in log deposits or changes in lines of credit. And on the right-hand side, I'm going to have changes in aggregate reserves and see if there's a correlation. Let's start with that, and then we'll go a little deeper. So what we do, and we're not the first to do this. Annette has a nice paper which does this along with Lopez Salido. And left-hand side, change in log deposits. Right-hand side, change in log reserves. It turns out, it's pretty strong and positive. Interestingly, when you separate demand deposits from time deposits, you have the positive on the demand, negative on the time. Okay. And finally, on lines of credit, it's positive. Now, when you do this in levels, this is just to show you the magnitudes. What you see on the columns 5 to 8 is every dollar of additional reserves leads to $1 of additional deposits. But this breaks up into $1.4 of demand deposits and negative 0.25 of time deposits. So essentially, you're increasing your demand deposits by more than the reserves you have and shrinking your time deposits. And that's the interesting part, that you're growing your demand deposits much more. Now, what about the pricing of reserves? If you take the effective Fed funds rate minus the interest on reserves as the price of reserves out there in the market, and run it against a bunch of stuff, what do you get? We're going to first run it again in levels and then say, well, levels is problematic because of collinearity and non-stationarity. Let's do it in differences, and we'll show you the results in differences. So when this is Annette's point, not ours, when you run the effective Fed funds rate minus the interest on reserves, this is how much entities get in addition by lending reserves into the market. basically there's no correlation with aggregate reserves, okay? And this is where, and it says, well, you got to put in deposits. And once you put in deposits, you have a nice, strong coefficient, negative for reserves. More reserves make liquidity cheaper, more deposits make liquidity costlier. And this is why she says at the aggregate level, you have to take deposits into account. You can break deposits into demand deposits and time deposits, and you see a much lower coefficient for time deposits. Demand deposits are the big thing. Now, you can do it for lines of credit. You can put everything together, similar relationship. And this is, again, inspired by Annette and Lopez Salido. When you have log reserves on the x-axis, the effective Fed funds raised minus interest on reserves on the y-axis, and just plot it raw, there's very little correlation. When you adjust for deposits, or as we find, adjust for lines of credit, or adjust for both, you get a straight line. In other words, you've got to put in the demand for liquidity that is being created by the reserves in order to get the pricing of reserves right. Now, macroeconomists will say, look, you can't run this regression. You have to do it in differences. We did it in differences. And once you do it in differences, it turns out reserves now start having a life of their own without necessarily correcting for deposits. But once you put in deposits, once you put in lines of credit, they do have an effect, especially demand deposits again, not time deposits. So things are being priced. But all this suggests that, you've got 150 observations. Depending on what you put on the right-hand side, you can pretty much get any result you want. Annette puts in household assets and she gives reserves. The problem is household assets have deposits in them. So you give reserves. You have to subtract deposits, you restore the value of reserves on explaining the pricing and the bottom line is we need to do something more detailed. So what we're going to do is essentially move from the aggregate time series because there's so much sort of confounding in it and look to a panel. And so we're going to look across banks. We're going to see, how does reserves at each bank sort of affect the deposits issues as well as the pricing of the time deposits that it issues. If what we're saying is right, that banks actually don't like more time deposits when they have a lot of reserves, we should see, for example, that higher the reserves at a bank, the lower they will pay for time deposits because they really don't want long maturity liabilities. Similarly, for the pricing of lines of credit. Of course, here we have to take into account the fact that reserves may be endogenous to particular banks, and so we have to instrument reserves with something which we think is more exogenous. So we do the instrument. We can talk about the details, but given the time, let me move faster. We do have an instrument for bank level reserves, which is a combination of the aggregate variation in reserves, which is exogenous to the bank, how much the Fed pumps up in reserves, but also the bank's utilization over time in reserves. Is it more a money center bank, therefore it gets more of a share of reserves, or is it more a peripheral bank, it gets less of a share of reserves? That durable share is the second part of the instrument. Put both those together, we think the instrument for reserves is relatively exogenous. Okay, so let me see.
The first part of that, I didn't quite get it. It's just got all the confounding factors in it again.
It's got the aggregate change, right? It's got the change, and it's seeing how the change, so it's got the aggregate change in reserves. Then you have what share historically these banks get of that any change, okay? And then we use that as the exogenous portion. What is the endogeneity we worried about? Think of a bank in stress, okay? Bank in stress may say, I want more reserves. I want to pull down my demand deposits and push up my time deposits because I'm trying to protect myself. That's the action it would do. You would find, therefore, the wrong predicted correlation than the one we have. In fact, if you run OLS with bank level reserves, you get a correlation like that for time deposits. So you need to correct for the exogenous component, and then you get the predicted direction. Okay, so what we find is more reserves does lead to more demandable deposits issued by a bank in QE, but no reversal of the claims in the post-QE period. Okay, so again, what we can't explain is why there's no reversal, but there is no reversal. Okay, so the first stage we explain reserves, second stage we explain deposits with the instrumented reserves. That's this two-stage estimation. I'm going to show you the two stages. Let me move to time and savings deposits. This is the demand deposits, and what you see is more reserves means more demand deposits issued by a bank. Remember, this is a panel, and we are correcting for time fixed effects and clustering by bank. You can put in a variety of bank characteristics. They really don't matter. The one thing that will matter is size. I'll come back to that later, but it doesn't affect the correlation of reserves with demand and savings deposits. Time deposits, you can see there's a negative correlation. Again, in the last column is the post-QE period. The first three columns are overall the QE periods and the first three QE periods. And you can see there's a strong negative correlation there. Reserves push down time deposits, but in the post-QE period, there's nothing. And in fact, that's what you saw in the aggregate numbers also. There's very little. And this really covers banks behave differently during this period. So one regression across banks doesn't capture what each one is doing. Okay. Similarly, you can find with credit lines. And again, given the time, I'm going to skip over it and basically say, trust me, with credit lines, you get the same. The coefficients are similar. More reserves means more credit lines issued. Okay. Let me go to pricing, which is the interesting part, right? So if the banks were in fact finding that reserves, basically you got a lot of reserves in a balance sheet, let me finance it the cheapest way possible. That means let me shrink the maturity of my liabilities as much as I can. So guys who have more reserves should, relative to other banks, shrink the interest rate that they're willing to pay on term deposits, because they don't want long-term money, they want really short-term money to finance the reserves. That's in fact what we see. You see the term spread actually go down as you have more reserves. Again, strong effects during QE, but no reversal during QT. So what you see here is on the left-hand side, the spread that you pay on time deposits. We have different time deposits, the 3, the 12, the 18-month, and the 24-month. And you see reserves strongly negatively correlated. The 12-month CD is a little weird, simply because 12 months is when you go from, if you break the CD, you get much of your money back. When it's less than 12 months, when it's more than 12 months, when it's 12 and more, a bunch of banks will force you to forego a lot of interest. That's why we think the pricing is a little weird, but the rest follow through. And we don't see this reversing during QT, which is the interesting part. Okay, let me again affirm that you see something similar with lines of credit. What's important to note with lines of credit is how do you price the spread on lines of credit? Well, with lines of credit, you have something called the spread if the line of credit is drawn divided by the undrawn spread. And that's a version of what is the price of liquidity you're charging? Because of course, only drawn lines of credit are really a charge on liquidity. And again, more reserves you have, the lower the drawn price levered relative to the undrawn price. And again, strong effects during the various sort of episodes of QE, but not necessarily during QT. Okay. So here's the question you've all been asking right from the beginning, right? So why don't banks shrink liquidity claims when reserves fall? So one possible answer is, hey, what are they doing when reserves fall? Maybe they're just doing that asset swap with the Fed. The commercial bank is selling the Fed or giving the Fed back the reserves and buying long-term bonds in return. So it's an asset swap on the bank's balance sheet. But if you think treasuries are really eligible securities, they get you all the reserves you need when you need them, why worry? Be happy. Okay, you can always repo. Now, the problem, of course, is you can repo with other banks, but that doesn't increase the aggregate supply of reserves. It's only when you repo with the Fed. But repos with the Fed mean you go to the discount window or the statutory repo facility, and we're not sure either of those works, which then means you're limited to repoing with other banks. Everybody thinks they're pretty well protected because they have high quality treasury securities which are eligible. Then you may have everybody feeling overly complacent that they're okay, because when push comes to shove and they try to raise the money from other banks, these will not be enough because there's paucity of reserves. The repo market will spring out. So this could be a possibility. They're all myopic. They see their eligible assets and they're happy. Well, so we looked at what happens if we put the ratio of claims to eligible assets. So we have lines of credit and deposits, divide by the eligible assets plus reserves. What does that ratio look like? But turns out that ratio is also going up. It came down during the QEs, but once QE ended, that ratio is also going up. So again, even when you take into account the real high quality assets in the bank's balance sheet, it's getting much tighter in terms of claims on liquidity versus what's available.
But Raghu, could I?
Yeah, go ahead.
I'm 2 slides ago, sorry. So the individual bank doesn't feel the quantity of reserves declining. The Fed has to sell treasuries. So the bank doesn't, if the bank doesn't want to buy treasuries from the Fed, it doesn't use any reserves. Now, the other possibility is the Fed sells the treasuries to somebody else who then takes money out of the bank. And now the bank naturally loses reserves because it lost a deposit. But the bank doesn't have to adjust to a decline in the quantity of reserves. It chooses its reserves, right? Or its customers choose to remove deposits, so they go away automatically. So
right. So John, at the beginning, I presented 2 balance sheet ways in which you just enunciated, and those could reverse absolutely, and those could happen mechanically. Of course, if what happens is an asset swap at the bank, that is, it is selling bonds, it is buying bonds and reducing reserves, then clearly there's an additional decision the bank could make, which is, do I rebalance my capital side? Even when what is happening is it's actually the public which is buying bonds and reducing its deposits at the bank still has a decision to make. Does it change the share of deposits versus capital on its liability side? But let's assume it does none of that. It still is the case that whatever is happening, passive or active, it still matters what the aggregate looks like. That's all I'm showing to you. I'm not claiming that banks are active or passive in either way.
I'm starting. So basically, the whole question is not sort of about the things you started with, these mechanical changes, but that banks, after having had more or less reserves among their investments, then they sort of have target ratios of reserves to other things, or target ratios of kinds of deposits to reserves, and then they voluntarily readjust those. And it's that second round that you're studying. Like, is that the
or the lack of the second round? Yeah, absolutely. So what we're saying is they have agency here. It turns out during QE, the agency is exercised towards issuing more claims than absolutely necessary to just accommodate its depositors. So, for example, there's no need for them to move from time deposits to demand deposits, but they seem to be doing that. There's no need for them to issue more lines of credit. They seem to be doing that. So it is active. The bank is active. And then on the reverse side, we don't see it reversing these things, right? And time deposits flatten out, demand deposits again flatten out during the period of QT. And that's why when reserves are shrinking, those ratios start ballooning. And that's the part that they're not playing an active role in accommodating what's happening, right? So this is credit lines divided, and this is the dispersion across banks, huge dispersion. Look, these numbers, 50-to-1 ratios at some banks.
How do you measure dispersion?
Big one?
How are you measuring dispersion? I don't know.
So we're just plotting the 10th to the 90th percentile of the ratio of credit lines plus demandable deposits divided by reserves plus eligible assets. And what you see is for some banks at the 90th percentile of this, it goes up to 50-to-1.
What's the profile of the banks that sit at the 90%?
Typically smaller ones. I'll show you. Next slide. So what you see is this is also the dispersion of those ratios over time. You see in QE1 to QE3, it's more to the left. That's the blue line, the blue bars. And with post-QE, it shifts more to the right. And of course, during QT, it shifts even more to the right. And that's the sense in which there's much greater dispersion in this ratio across the banking system. There's some guys who are really, in Warren Buffett's parlance, swimming naked. Okay, this is what is happening by bank size. And this is the one characteristic we find matters. You don't find equity, you would think John talked about capital ratios and so on. We very crudely look at equity capitalization and so on. Those don't seem to matter. What matters is size. It's the largest banks, that is the red line there, the above 90th percentile in size, that go up during QE. And post-September, this is up to September 2019, they're still rising in this ratio and then come down fast. Many of the smaller banks continue rising until you hit the pandemic. So essentially, whatever adjustment is taking place very slowly, and the larger banks seem to adjust a little more than the smaller banks. The dashed line is you get the smallest bank, the below 10th percentile is way out there. So I think basically this says there's a lot of dispersion within the banking system and how these people adjust, but all of them seem to be going up in this ratio during QE and reverse only modestly during QT. So million-dollar question, why doesn't this happen? Why don't banks shrink liquidity claims when reserves fall? One could be organizational constraints. How do you withdraw a line of credit from a relationship client? You may have a wholesale deposit desk, and if you don't know that you won't need them, it may be hard to close, and they keep raising the money. Certainly true of retail deposits. You've opened branches to raise retail deposits. Hard to close them down or tell them, please don't deposit in me. You can reduce rates, but that's a relatively crude tool. But moral hazard may be the other point that we've already talked about. The Fed will come in times of need, since stress will show up in Treasury repos. If the Fed is automatically programmed to intervene when stress shows up, then you can rely on Fed intervention. And then what are the costs of Fed intervention, right? One, of course, is the market underprices liquidity, enhancing the need to intervene. It's very easy for the Fed to get in, hard to get out. The notion being of a whirlpool, you get in when you do QE, but very hard to get out because the system sucks you in again and again. There's a distortion in financial activity. You tend to do stuff that requires liquidity. Speculative activity is something that comes to mind. Requires infusions of liquidity when you make big losses, but that may be what you are driven to. And there's a distortion in real activity. If financing becomes real short-term, then what is it that you finance? Short-term real stuff.
How hard is it to tax these activities that place strain on the net liquidity of the system during crises? Why can't you tax lines of credit? Why can't you tax deposits, demand deposits relative to time deposits, and so on? Is that going to miss too much of the? Or is it going to just shift the activity elsewhere?
It's yeah. So you've two answers. One, it is relatively crude. There are some banks that are better off financing with demand deposits unless you say this is completely unnecessary. So it's more a supervisory suggestion rather than something you would tax. But the second is it shifts outside. I mean, we've seen how many entities have bank-like structures, right? FTX. Right. The crypto exchange had a bank-like structure, and we didn't know it. And I think there is sort of this demand for liquidity, which would be sort of which will show up somewhere, so long as the Fed holds the price of liquidity down. And so the question more is, should you restore the price of liquidity to the right place?
How do you do that if you're going to intervene in liquidity crises and you're not going to tax these activities? What's left?
So I'm saying. Well, so my pet policy is, I don't see the benefits of QE that much. I see significant costs, and I would say we need to consider very carefully whether we do it again. But I think I'm with John on this one. But let's
other to give reasons why you can't just undo this.
Well, if the question is, it has to be undone by the banks. The banks are willing to let go the reserves, but they're not willing to let go the liabilities they write on the reserves, the claims they write.
I'm sorry, maybe I would jump ahead, but what if the Fed just started to reduce the bonds, just buy fewer treasuries and fewer mortgage-backed securities?
Are you saying don't do QE in the first place?
No, now undo it.
No, so if it sells,
I agree
if it shrinks its balance sheet, what I'm saying is the banks are reacting by giving up the reserves and taking the bonds that the Fed sells, and are still sitting with that same level of liabilities that they had earlier. Now, one could be naively, they all think they will get access to final settlement reserves when they use the bonds in their balance sheet. The other could be they just think the Fed will come back in whenever they need it.
Why couldn't you just let them go to the discount window next time, charge them penalty interest rates, and say, look, this is how we're going to deal with the next liquidity crisis. You come to the discount window if you need help.
That's the budget rule, right? We could have done that in September.
Yeah, but maybe that was a mistake, not to do it that way.
So yeah, that would be another way. But it's not going to help this time because they're all going to.
Understood. We're going to do it at least once to
you got to do it once. Stick. And you remember what the Bank of England did? It basically said you have 2 weeks to get your stuff in order and don't expect us to be around after that. And that the problem there, and that's where the last two come in, is the Bank of England, as I understand it, was very worried that this would send the wrong signal just when the government has torpedoed its own balance sheet. The Bank of England is now going to buy everything the government is issuing, and that would kill your ability to deal with monetary, with inflation. It also would look very much like permanent fiscal financing. So very important at that time for the Bank of England to say, thus far and no more. We're coming in, but only for a little while, get your stuff in order. And of course, there was distress selling by those guys, and there was some talk that some of the hedge funds made money off this. But that was part of the answer, so to
That-
speak,
yeah.
to restore discipline, right?
Exactly. So they've got to have a penalty somehow, or we're never going to get out of this problem.
Exactly. And I would say next time around, don't initiate it.
What about the last couple of tickets? So you didn't.
Yeah, I was saying one is this monetary financing that monetary function. It sends mixed signals when you're buying long term, which typically is done to reduce the long term rate, and you're raising the short term through policy rates. So you're sending mixed signals on whether you want to tighten or not.
Well, now they're just doing the funds rate. They're not doing the balance sheet's constant.
Balance sheet is falling in the Fed.
Only a bit,
Yeah, they're 95 million a month, 95 billion a month. So they are reducing their
What's the
balance sheet.
same direction?
It's going in the same direction. Absolutely. But the question is, what happens when they eat through the reverse repos and they start eating into bank reserves?
Just one follow-up.
Yeah.
If this is if this is the optimal solution to make them come to the discount window next time.
Yeah.
Then to mitigate the size of the next liquidity crisis, the Fed should be announcing this.
Yep.
They shouldn't be just like, we're going to do it.
Yeah.
They should be telling the banks in advance, we're going to do it. Is that
The
something?
problem with those kinds of announcements in a market that's already fragile, so liquidity, people say, is already tight in markets by their standard metrics, is that you may, look, markets are on tenterhooks. Where's the next FTX going to?
Yeah, I take the point. You want to think carefully about when you start making these announcements.
Yeah, I would say in calm times, say, look, we're out of it. But remember, Powell tried to do this, get away with from the Fed put in December 2018, until he was brought back kicking and screaming to bail out the market, right? Nothing changed.
That was a somewhat different episode.
It
than what
was.
we're talking about
It was
now,
not
right?
this, but it was a situation where, the Fed put was
Yeah.
verified because all that changed was the market swooned. And there was a sense, oh, wealth effects, this, that, etc., and President Trump shouting from the sidelines. So we better do something. Anyway, I'm way past my time. This is plenty. I should stop now.
So can you do a counterfactual?
In what sense?
Well, suppose they didn't do the balance sheet expansion in the first place, or if they more aggressive now, something.
So I've read all the papers on benefits of QE, and most of them work in fairly indirect ways, right?
Right.
You had, QE in Europe. Oh, that worked because you bailed out the periphery countries. And because you bailed out the periphery countries, bonds that banks held of the periphery countries went up in value. That increased the bank capital, and banks could go out and lend. Seems to me there are more direct ways of doing that. Tackle the bank balance sheets. So I think a lot of the effects of QE seem to be indirect rather than direct. The direct effects, I think, portfolio balance, I don't think we have a lot of evidence for that. You take off the long term from private portfolios, they go out and rebalance with long term, real financing. I don't see that happening. I think Annette and Arvind have a view that the signals the time before you actually tighten policy. And certainly for the Fed, it seemed that first we have to finish QE, then we will start tightening policy. That may have, in fact, delayed the process of tightening, but that may be. So I don't see much value. What's that?
Did they have to stop?
I think it's they've created an instrument. There is no forward guidance, has no teeth behind it. Let me create effective forward guidance by saying, first, I'm going to end QE, and then I'm going to raise rates. So long as I'm doing QE, and I tell you I'm going to do it for a few months more, believe me, I won't raise rates, even if stuff goes to hell. And turns out stuff went to hell before they raised rates, and they may have been behind the curve. But they established an instrument for the future, which may be the silver lining in that cloud otherwise.
Okay, can I just pursue back to discount window operations? I'm remembering the capital infusions that banks were forced to take during the finance. Some of them needed it, some of them were compelled to take. that was another episode where it seems that the motivation was to avoid casting blame on individual banks in order to prevent, I guess, panics
Yeah.
spreading from those banks. But it's the same, it creates the same problems.
Right.
Then the banks that are behaving most egregiously
Right.
with respect to exposing themselves to liquidity crises
Right.
don't suffer any particular penalty.
Yeah.
And you just set the stage for another liquidity crisis the next time.
Yeah.
So it's not just about QE. It seems
Yeah.
to me it's about this desire to diffuse the cost to the entire system rather than to banks that are most egregiously
You're
designing their balance sheets and their liquidity structures.
you're talking about a philosophy
Yes,
which
exactly.
has permeated the system, which is let's not talk about what this does to incentives over the long run. Let's deal with that after the crisis.
Right.
Let's do everything possible to resolve the crisis and talk about moral hazard afterwards. You never talk about moral hazard afterwards. Very, very, very
Yeah,
little.
exactly. So that means you need to deal with it you need to resolve the crisis, but also mitigate the moral hazard problems at the same time. And
Yeah.
I agree, that wasn't the thinking.
And it would take a brave central banker to essentially let the chips fall where they will when they're dealing with the moral hazard on their watch. It's always better to let somebody else deal with moral hazard. No,
Okay, fine, fair enough. But we got away from the idea of a discount window as the way to resolve liquidity problems.
Steve, you're absolutely right. I'm just saying the political economy of this stuff and the incentives.
Okay,
make
so,
it
but I'm
very-
asking now for an explanation of how did that unwind intellectually, philosophically? How did it unwind? I just don't know.
Yeah, I think it's straitjacketing. It's saying that, and even straitjacketing at the right time. So Congress saying thou shalt not do this. Well, the problem with that is there will come a time when it's really convenient to say, okay, go ahead, do what you need to bail out the system. So it's very hard to build strong incentives into this unless you have, some really independent, politically totally isolated person who worries about the long run rather than their image in history. So long as they worry about their image in history, they don't want to be associated with the collapse.
Fair enough.
Can you say something about other central banks, about other central banks and how they fit into this discussion?
Well, so here's the thing that we think this sort of outlining all this, the deposit side, we didn't know, we didn't read it anywhere. And I think people are discovering, so we heard from some other central bankers after we gave this talk at Jackson Hole, oh yes, this is what's going on in our place. Now, some places not going on. Euro area, I think they bought bonds from the banks themselves. So the deposit stuff is not showing up as much. But it varies. But I think this is something that, now we're more cognizant of. Maybe we will pay more attention to it. But getting academics to recognize this as a problem itself is difficult. This is all central bank mumbo jumbo. It's not serious. And so we're struggling with persuading monetary policy, monetary economists that this is worth looking at, that this is part of the answer.
Question online.
Andy Filardo has a question.
Yeah.
Great presentation. I had one question. One issue that didn't come up was the supplementary leverage ratio. So, in 2020, the Fed sort of relaxed that, and that was basically the capital charge on reserves and treasuries. And it was only in place for about a year or so. But I'm wondering, I'm generally on board with what other people are talking about. Let's not do this again. But given we are here, would the supplementary leverage ratio be the way to sort of counter some of the concerns you have about, too many, assets being produced by the banks in the QT period?
You mean constrain them with the supplementary leverage ratio? Because as you know, there are a whole bunch of people who are saying that you should actually eliminate it for reserves because, you're preventing the banks from holding adequate amounts of reserves and lending them out. Yeah, no, look, I think trying to get a whole holistic view of bank balance sheets as this process is going on is certainly part of the answer. It does strike me that even though there's a lot of complaint about the liquidity coverage ratio, we should look at whether it needs to be broadened beyond the relatively large banks across the system, and to see there's adequate liquidity available within the system. But yeah, I think there are various options possible. But the first thing is to recognize this is a problem. That's the battle we're trying to fight first. But yeah, more needs to be done. I think the SRF standing repo facility, if it can be made to work, could be part of the answer. But I think again, just supplying more reserves down the line may sort of make this problem worse rather than better, for the same reasons that Steve has been talking about. So we have to find an answer other than saying, yes, we'll be around when you need it.
What kind of reform would you put in place given all this?
I mean, it goes back to, I think we should re-examine the value of QE. I think that I don't see.
Just not do QE, just forget QE.
I think QE is repair. QE as repair, I think, is really useful. That's sort of more like the emergency liquidity facilities that central banks provide. We've moved from emergency liquidity to permanent liquidity. That is the mistake, because then you're locked in, and permanent liquidity creates more demand for permanent liquidity, and then you get this this ratchet effect. I think emergency liquidity, that's where it should stick to.
Well, the two answers, speculative answers that you gave, right, about why this might be happening. One could be just a time effect, right? The unwind some of these relationships might take longer than a year or two, versus the other that they're counting on whatever might happen.
Well, so there we point to the 4-year period between end of QE3 and 2019 when they resumed QE again. And you didn't see a rapid decline in these claims on bank balance sheets. So they had 4 years. If 4 years is too little, then they're really not doing it.
More questions on
Andrew Levin has a question.
Yeah, just a comment. I thought it was really, really interesting. As far as the benefits of QE4, I think that a big part of QE4 was purchasing mortgage-backed securities, and I'm just curious your thoughts about that, because it's easier to understand why the Fed did that in late 2008 and 2009. When there was a housing crunch. It's really hard to understand why the Fed was buying mortgage-backed securities in 2021 when the housing sector was booming and probably experiencing a bubble.
I think great point. I would agree with this first part of the statement. Absolutely, it may have been useful in restoring life to the mortgage-backed market in 2008. That's what I meant by repair. And I would agree again with the second part, which is why distort prices of anything that is private or for that matter public but when things are reasonable. And it seemed that this mantra of we need to do it for the time we said we would do it essentially became the guiding light. And there I think we also need to revisit this process. Absolutely. And you can see the reverse. When it stops supporting the market and starts selling the stuff, we've seen long-term mortgages sort of spread out now to 7% plus. And so you may actually engender more volatility by suppressing and then letting it go.
Another point that's worth mentioning is that in QE 1, 2, 3, the Fed was trying to push down the term premium, And that was plausible when longer term rates were up in the twos. Whereas in 2020, you know, the longer term treasury yields were already at or below 1%, and there wasn't very much room to push down the term premium. And in fact, it didn't really decline after they launched QE4. And meanwhile, the interest rate risk that they took on turned out to be enormous. And the estimates now, Bill Nelson, I've been working on this, you know, is that this could cost US taxpayers $1 trillion, you know, because the Fed essentially, you know, bought high and it's selling low, if you want to put it that way, you know, completely counterintuitive.
Right. No, absolutely. I think that's exactly right, that there's no need to push. It's sort of liquidity without benefits, right? That they did at that time. The other point, you know, to the cost to the US government, essentially what you've done is you've swapped longer term government debt for overnight sort of Fed debt. And that has implications as interest rates rise, right? You're starting to pay much higher rates much more quickly because the government hasn't sort of offset that by issuing much more longer term debt on its portfolio. So the debt with the public is much shorter term, and that has its costs also in addition to the interest rate costs you're talking about.
Could I like to object to your statement that permanent liquidity is a bad thing, because I take exactly the opposite conclusion. But what I get here quite loudly is that mucking around with liquidity in the halfway zone is a bad thing. But why isn't the conclusion, let's really undistort things? Let's follow the Friedman rule. Let's make the whole place so completely awash in liquidity that changes in liquidity don't matter. Let the Treasury issue $20 trillion of fixed value floating rate debt if it wishes. I agree with Andy. We could take care of the interest rate risk with a gigantic fixed for floating swap. But why not? Why should they not issue all the liquidity in the absolute world and leave it out there and live the Friedman rule? And then, as Bob said earlier, you want to affect, raise and lower interest rates is how you run monetary policy and affect inflation. There's no idea that offering unlimited liquidity will lead us to hyperinflation. So why isn't the answer go all the way and stay there? Well,
first, if you believe what's in this, what we've seen, that these guys are going to demand yet more of what you put out there,
not in unlimited quantities.
How big are you willing to get? Yeah.
And so the undistorted price is the one with infinite liquidity, and anything else is a distortion. And so, let's just go to whatever they would choose under infinite liquidity, which would be,
right,
some combination of term and demand deposits, and fine, let them sit there.
Right. Look, we should probably have this conversation offline. But what are the costs of a huge Fed balance sheet in what it engenders in government activity and so on? I think that's also worth debating. It's not that government activity remains constant regardless of the size of financing you provided.
I agree. That's why I said the Treasury should offer essentially reserves in unlimited quantity. All we're doing here is we're offsetting the fact that those morons at the Treasury sold too much long-term debt, not enough short-term debt, and don't know what a swap is. But no, that can be fixed.
Okay, I'm not going to get into that debate.
We'll do that later, Raghu.
We'll talk.
This is great. Thank you.
Thank you
so much.
Thank you very much.